All right, let's dive right into this explainer. Today, we're demystifying a topic that is literally the bedrock of the modern global economy, and that is sovereign debt. Now, I know that phrase often conjures up these scary images of impending doom or financial ruin, but today we're going to break down the actual anatomy of how government borrowing works, why it happens, and what it really means for our future. And we are starting with a number that is, honestly, kind of hard to wrap your head around. $88 trillion. Seriously, take a second to just think about all those zeros. This is the staggering current estimate of global government debt. It's a massive figure, and it's been driven up by historical crises, those huge pandemic-era stimulus packages, and just persistent fiscal deficits all over the globe. When we hear a number that incredibly large, it's super easy to panic. But right off the bat, we need to bust a massive myth. National debt is not exactly like an overdrawn household credit card that's just inevitably going to end in imminent national bankruptcy. The reality is far more complex, and actually it's pretty fascinating. Sovereign debt is a highly structured, absolutely vital financial tool used by states. It's what allows nations to absorb massive economic shocks, fund critical long-term infrastructure, and actually stimulate growth. So it's really less about a maxed-out credit card and way more about strategic macroeconomic management. So where does all this actually start? Well, the crucial point is understanding that it all begins with a budget deficit. Think of a government just like any large organization. It has revenues, mostly from the taxes we pay, and it has expenditures, which cover everything from public services and healthcare to national defense. When a government spends more than it earns in a given fiscal year, it runs a deficit. And to bridge that gap, well, it can't just leave its bills unpaid, right? It has to borrow. Let's walk through the actual mechanics of this borrowing and trace the four-step life cycle of sovereign debt. Okay, so after running that deficit, the government issues financial instruments. Usually these are things like government bonds or treasury bills. Then, investors purchase these bonds, which essentially means they're lending their cash to the state. In return, the government promises to repay that original principal amount on a very specific date, while making regular interest payments to the investor along the way. Now, a key thing to remember here is that it's the sovereign state issuing this debt, not the citizens directly. Although, obviously, we as citizens do ultimately bear the burden of repayment through future taxation. Moving into our first major area, the catalysts. Why exactly do governments deliberately rack up this debt in the first place? Historically speaking, you can think of debt as a giant macroeconomic shock absorber. If you look back, the massive spikes in national debt perfectly mirror our timeline of global crises. Think about the Great Depression, the 2008 financial crisis, or more recently, the COVID-19 pandemic. During these times, tax revenues just plummeted because businesses were struggling and people were losing their jobs. But at the exact same time, the need for government assistance absolutely skyrocketed. Deficit financing is the tool that allowed governments to keep vital services running and inject money into the economy, which ultimately prevented total economic collapse. But it's not just about putting out fires or financing wars. Even though, yes, funding national security has been central to state survival since the Napoleonic era, debt also funds absolutely vital long-term investments. Governments borrow to build national highways, upgrade energy grids, and fund education. The idea is that these investments will yield long-term economic dividends that actually outweigh the interest costs. But we also have to talk about political realities here. Raising taxes is, well, it's deeply unpopular. And cutting services? That's just angers constituents. So this creates a classic tragedy of the commons scenario. Politicians are structurally incentivized to keep spending high and taxes low, and they simply fund the difference through borrowing, just to secure short-term electoral wins. Which brings us to part 2, the creditor web. Just who exactly is owed all of this $88 trillion? This completely debunks a really pervasive myth. People often picture this shadowy foreign cabal holding all the world's debt and pulling the strings, but the reality is a vast, incredibly complex web of creditors. Sovereign debt is a highly liquid, globally traded asset class, and the truth is, for advanced economies, the vast majority of the national debt is actually held by domestic investors. That essentially means we kind of owe it to ourselves. The bedrock of domestic debt is held by institutions that require incredibly safe, reliable assets. We're talking about the pension funds managing your retirement savings, insurance companies, local commercial banks that need to meet regulatory requirements, and even everyday private citizens holding savings bonds. So the interest paid out by the government, it actually goes straight back into the domestic economy through these exact channels. Now, meanwhile, in our era of globalized capital, foreign investors absolutely play a major role too. Foreign central banks, especially in countries with large trade surpluses like Japan and China, they invest heavily in the debt of countries they trade with, like U.S. treasuries. Why? Well, they do this to stabilize their own currencies, manage exchange rates, and just find a uniquely safe haven for their export profits. Plus, global hedge funds and international asset managers are constantly buying foreign debt looking for a reliable yield.
All right, let's pause here for a second because I know what you're probably thinking. If debt is just a normal, everyday financial tool held by our pension funds and central banks, at what point does it become a catastrophic risk?
The secret here is that economists don't just look at the raw dollar amount, they look at the debt to GDP ratio. That is the total debt measured against the total economic output of the country. Think of it like this. A massive economy can safely carry a massive debt, kind of like how a billionaire can safely take on a way bigger mortgage than an average middle-class worker. The real danger strikes when the accumulation of that debt significantly outpaces the actual economic growth of the country.
Because if that debt grows too fast, the consequences are severe. First off, debt isn't free, right? It carries interest. And eventually, massive interest payments begin to eat up the national budget, diverting crucial tax revenue away from public services. Secondly, when a government issues a flood of bonds to borrow massive amounts of money, it can actually crowd out private investment. By offering higher interest rates to attract buyers, the government drains available capital out of the private sector. That leaves less money for businesses and entrepreneurs, which ultimately stifles innovation and slows down overall economic growth.
And there is a really sharp, frankly tragic contrast here between advanced economies and developing nations. Advanced economies largely get to borrow in their own stable currencies from domestic sources. It's relatively stable. Developing nations, on the other hand, often lack the credit rating to do that. So they are forced to borrow from foreign creditors, like multilateral development banks or bilateral creditor nations. And they have to do it in foreign currencies, like the US dollar. This creates an absolutely devastating debt trap. If a developing nation's local currency loses value, the relative cost of their foreign currency debt skyrockets instantly. They don't even have to borrow another dime for their debt to explode. This massive outflow of capital forces them to slash essential domestic spending. Ultimately, this can lead to sovereign default, which is when a government simply cannot make its payments. And because you can't just liquidate a country in bankruptcy court, defaults trigger chaotic restructuring, capital flight, currency hyperinflation, and deep, painful economic recessions. We've seen this historically in Latin America, and more recently in nations like Sri Lanka and Ghana.
So, to wrap this up, sovereign debt is neither inherently good nor inherently evil. It is a powerful mechanism. It allows nations to weather massive storms and build for the future. But that line between strategic borrowing and fiscal irresponsibility, it is incredibly thin. So as global debt hits these unprecedented post-pandemic highs, I want to leave you with this final thought. How will we balance the undeniable necessity of public investment with the absolutely inescapable mathematics of debt sustainability? Thanks so much for joining me for this explainer, and keep questioning the numbers.